Hello everyone, welcome to my channel. So today we are going to discuss ratio analysis. Before discussing ratio analysis, let's first move on income statement. So firstly, we take sale and we deduct cost of goods sold. Then we get gross profit. Let me change the color first so that you can understand easily. Okay. So we deduct office expenses, selling and distribution expenses from the gross profit. Then we get operating profit. Okay. So and from operating profit we deduct non-operating expenses and we add non-operating income, and we get profit before interest and taxes. And by deducting interest we get profit after interest and before tax. And by deducting tax we get profit after tax, and that is also known as net profit. It is very important. Okay. Okay. So now we deduct preference dividend, we get profit for the equity shareholders, and we deduct equity dividend, we get profit in balance sheet, that goes in balance sheet. Okay. And there is another, like you might be confused, but this is like we can say other. This is also used in marginal costing and many more. Like this is also important. So here what we do. Firstly, we take sale, we deduct variable cost, then contribution came, and then we deduct fixed cost, then earning before interest and taxes, we deduct interest, then we get this profit after interest before tax, then we deduct tax, then we get here a profit after tax, or we can say net profit. Okay. So now let's comes on ratio analysis. So firstly, this is divided into 3 to 4 parts, like liquidity ratio, solvency leverage ratio, activity turnover ratio, and profitability ratio. Okay. Okay. So before going into deep, like let's first analyze the meaning of this. So meaning of these ratios. So firstly, we talk about liquidity ratio. So what does it mean? It means that how easily can a firm pay its immediate bills, like we can say short term bills, or we can say within a year. Okay. So this include 3 ratios, that is current ratio. The formula of current ratio is current assets divided by current liability. And now what does it mean? It means that how much current assets are there to pay current liability, and the ideal ratio is 2:1. That means you have two current assets to pay one current liability. That is the ideal ratio. Okay. Now next is acid test, or we can say quick ratio, which means quick assets divided by current liability. And quick assets is like from the current assets we deduct inventory and prepaid expenses, so it comes as a quick assets. And why we deduct inventory? Because it takes more time to convert into cash, that's why. So it means that instant ability to pay debt, that I told you. And but if we compare, like quick ratio is more liquid than current ratio, because we deduct inventory here. Now next is cash ratio, or we can also say it sorry, absolute liquid ratio, which means that we are only using the cash to pay our debt, and the formula is cash and cash equivalent divided by current liability. Okay. So here we completed our liquidity ratio, and I hope that you are understanding very well, you are getting what I am trying to tell you. Now we have another ratio, that is solvency and leverage ratio. So firstly, let's make the relationship between them. Okay. To understand more clearly and for the better understanding. So firstly, liquidity ratio is for the short term liability, we can say, but solvency and leverage ratio is for the long term debt. It means that company can pay, like how efficiently a company can pay long term debt and how much depend on borrowed capital. And we can also understand in a way that a company or a firm, can a firm survive in long term? This is the question. So now here these are some ratios that comes under the solvency or leverage ratio, that is debt equity ratio. What does it mean? It means that the proportion of debt and equity in financing assets. And the ideal ratio we can say, like if there is 1:1. So what does it mean? That equal debt, one debt and one equity, debt and equity are equal. Okay. Next we have the total assets to debt ratio. What does it mean? Like total assets divided by debt. Okay. So here and next is proprietary ratio, which means the formula is proprietary fund, shareholder fund, or we can say equity divided by total assets. What does it mean? It means proportion of owner's capital in total asset. Okay, and suppose we have 0.6. What does it mean? Like 6%, that means 6% assets belong to the owner. Okay, so this is like from the total assets, the proportion of 6% is belong to the owner. Okay. Next we have debt ratio. The formula is total debt divided by total assets. And what does it mean? That how much assets are financed by debt. Okay. Like suppose you have 0.4%, or we can say, what does it mean? 40% assets are financed by borrowing only. Okay. Baki we can say that 60% is from our own equity or own assets. Now here next is, these are some additional ratios. That is first one is interest coverage ratio. So now interest coverage ratio is more important. Like it is very important, because there are many numericals in NET, JRF and various competitive exams or commerce exams. So what is the formula? That profit before interest, tax and dividend, we can say EBIT, earning before interest and tax, divided by interest on long term loan or borrowing, or we can say simply say interest. So what does it mean? It means that ability to pay interest from profit. How much interest you can pay by your profit only. So here like EBIT divided by interest, that is, suppose EBIT is 5 lakh and our interest is 1 lakh. So here the ratio is 5, which means profit covers interest 5 times, which is a good sign. Okay. So here next is the debt service ratio, which means profit after tax before interest divided by interest on loan debenture plus installment, we can say interest only. And next we have capital gearing ratio, which means debenture loan plus preference share divided by equity share. These are less important, we can say. And now we have other one, that is activity turnover ratio. So what we were doing here, liquidity ratio is for the short term, here solvency leverage ratio is for the long term. Okay. And here activity turnover ratio means that how efficiently assets used to generate sale. Turnover means sale, you can say. So here what does it mean? Stock or sorry, we can say inventory turnover, stock turnover ratio. What is the formula of it? That is cost of goods sold divided by average inventory. Now what is average inventory? Average, you know, that like opening stock plus closing stock divided by 2. And what does it mean? Cost of goods sold, and the formula is like sale. If you are having the sale and you are deducting your profit, then you will get cost. Okay. So this is the same, cost of goods sold, like equals to sale minus gross profit. And the other formula is opening stock plus purchase, whatever you have purchased, and what are your direct expenses minus a closing stock. Okay. Now so what is the means of this inventory turnover? Here, like how many times a stock is sold in a year. Suppose you have the answer is 8, you have 8. So what does it mean? That stock is sold and replaced 8 times, which means if in a year like your stock is replaced at 8 times, then it is efficient, you are earning well. Here, now next we have debtor receivable turnover ratio, which means that how quickly credit customer pay, like how quickly you are receiving your money back. Okay, the formula is net credit sale divided by average trade receivable, and formula of average trade receivable is opening debtor plus closing debtor plus bills receivable, if the bills receivable is given in the question. And next, net credit sale, you well very well know, like total sale subtracted by cash sales and sales return, you will get net credit sale. Okay, now next we have credit payable turnover ratio. The formula is net credit purchase divided by average trade payable. Now, what is average trade payable? It is the same as average trade receivable, which means opening like ye sorry which means opening creditor and closing plus closing creditor plus opening bills payable, or we can say closing bills payable divided by 2. And the mean is that how fast a firm pays its suppliers, how efficiently the firm is paying its debt, we can say. Now next we have fixed asset turnover ratio. The formula is sale divided by net fixed assets, and if cost of goods sold is given, then like if sale is not available and you have cost of goods sold, then it is this. And now the means is that how efficiently fixed assets generate sales. Okay, if the ratio is 3, it means that rupee 1 in fixed assets earn rupee 3 in sale. Okay, next we have current asset turnover ratio. The formula is sale divided by current assets. It is very simple. Now here you can see easily, if you are understanding the meaning of, if you are able to understand the meaning of the thing, like here you can see the debtor turnover ratio. If you are understanding the meaning of this, then you would be able to make the formula very easily, like what that I told you, that debtor turnover ratio is net credit sale, that you are selling on credit, divided by average trade receivable, how much you are receiving average. And now next, we were at working capital turnover ratio. So here formula is very simple, sale divided by working capital, and the means of this ratio is how well company uses working capital to generate sale. And if the ratio is 5, then it means that rupee 1 working capital generate rupee 5 sale. And I think by this example you are getting what I am trying to tell you. Okay, next we have profitability ratio. So here liquidity ratio is for short term, solvency ratio long term, activity ratio like that I told you, that how efficiently assets used to generate sale. And then we have profitability ratio. Now what does it mean? How efficiently a firm generate profit, and we can say how much money company is really making. Okay, now, so what are the formulas? We have gross profit ratio. What does it mean? It shows profit after cost of goods sold. Suppose you have the 40%. So what does it mean? Like for every rupee 100 in sale, rupee 40 is gross profit. That is very good, that you are less than half, less than 50%, but you are earning gross profit very well. On 100 you are getting 40 rupees as a profit. That is very good. Okay, so the formula is gross profit divided by net sale divide into 100. And here it is the same as like we can say profit equals to sale minus cost. It is the same formula, like gross profit equals to sale minus cost of goods sold. Okay, now next formula is net profit divided by net sale into 100. it is, what does it mean? It is the final profit after all the expenses. Okay, it is the final profit. Now here it is operating profit ratio, means operating profit divided by net sale into 100. Next we have operating ratio, or we can say operating expenditure ratio. You can say it is operating profit, you can see, but here it is operating ratio and operating expenditure ratio. So what is the formula? Total operating expenditure divided by net sale into 100, and total operating expenditure means it is the cost. Here the mean is that total operating cost compared to your sale. Okay, so now next we have return on assets. The formula is net profit divided by total assets into 100, like how much profit earned per rupee of total assets. Okay, and here return on capital employed, or we can say investment, that how much return you are getting on your investment, we can say, like total capital used, return on total capital used. Okay, and it is really very important formula. You must you need to remember it. It's like these formulas are very basic, and these formulas should be on your fingertips. Okay, next we have return on equity, that is profit after interest, tax, and preference dividend divided by equity fund into 100. Okay, what does it mean? That return to, it is the return to owner only. Okay, so return on equity means return to owner only. Now next we have earning per share. Now the formula is net profit after tax divided by number of equity share. What does it mean? It shows profit per share. Okay, now these are some additional ratios that I am going to tell you. Like it also comes in exam. So here price earning ratio, which is sorry, market price per share divided by earning per share. It shows market confidence and valuation. Next we have dividend yield ratio, dividend per share divided by market price per share into 100. It is the investor return on investment. Dividend payout ratio, dividend per share divided by earning per share into 100. It shows how much profit is distributed as dividend. Okay, dividend payout ratio. Now book value per share, shareholder equity divided by number of equity share, like it is the intrinsic value per share. So this was all about that. I think we have covered all the formula, but here is that thing remain. It is very important, you need to understand it. So here what is it made? Like equity share capital plus preference share capital plus reserve and surplus minus fictitious assets, or we can say loss expenditure equals to equity share equity, or we can say shareholder fund. And if we are adding loan or debt in this, then it become capital employed. Okay, how much capital employed in the business. And if we add current liability in this, then it is the total assets we have. Okay, now, or we can say if we are removing preference dividend, then we get only for the equity share. So I think we have completed, we have covered all the things that is in ratio analysis. And within a diagram you can take screenshot of it, and I think it will be very helpful. You can watch this video again to get more understanding. So thanks for watching, have a nice day.